All right, we're live, and this is an update to the S&P crude ratio trade that I talked about last time. I think it was about a month and a half ago. It's been a while. Hello, and this is where we were at that point with the um, blue line being the ratio itself. So that's the number of barrels of crude required to buy the S&P. The yellow line would be the 50 I'm sorry, the 200-day moving average, and the orange line on the bottom there would be the 50. And the hypothesis was that that was overextended and would return to the 50-day moving average, the orange line. And as we can see, it did just that, and then continued. So much so that we uh, now my thesis is actually that this is overextended, meaning I think that we're going to see weakness in crude and relative strength in the S&P going forward. Um, if we're looking at the 2008 reference case, which I think is a good reference, 2007, 2008, what you saw for a lot of that period was the 50-day moving average of the ratio. Okay, so the orange line in this case, acting as resistance, meaning every time it would touch that line, crude would find support, and the S&P would encounter resistance. So that's the general thesis that I'm operating from. If we look at the couple things. One, this is the okay. This is kind of an interesting graph. It takes a little bit to explain what this is. What we're looking at is the distance in percentage terms. So this y-axis should be, I think this is log change, but it's close enough to percent. You can think of this as percent. So here, crude oil was roughly 18% above its 50-day moving average. Very overextended, okay? In 2007, 2008, the price high actually came after the max difference from the 50-day moving average. And 2.5 weeks after the max difference from the 50-day moving average. So basically, that would imply that the price high in crude will come in a week and a half, if it plays out the same way. I guess I'm not real excited about shorting crude here, frankly. I see a fair amount of risk to the S&P. The S&P got very close to its. Let's look at a chart now. So the S&P is reacting to a bad CPI number today. It got very close to the 50-day moving average, which would be the kind of the classic retrace. But there's now this threat, shall we say, of an intra-meeting Fed funds rate. And so the market's not liking that. That's now all of a sudden, a negative, a potential for, significant downside in the S&P. However, I think the most likely thing is that we don't get that. There was just rumors of that. Oftentimes rumors of that don't come to play and don't come to pass. And it could kind of provide some like bullish fodder that it didn't happen, right? So we're losing the narrative. We're losing the forest for the trees if we focus on, does the February rate hike occur or not? That doesn't really matter. What matters more is that CPI came in, 0.2% on a monthly basis over expectations. That's a huge miss, especially considering where we're at. So I think it does put the 50 basis point hike in March into play. And frankly, I see that as a catalyzing event for another leg down in the S&P. But that's a month and a half off. Actually, I'll have to check when the Fed meeting is, but it's February 10th today. Let's just take a look. Federal Reserve 2022 meeting schedule. March 15th to the 16th. So we're talking about 23, 24 trading days from now. Okay, so that's a lot of time. I do think, that's going to be the catalyst for the next leg down. I'm guessing there will be a fair amount of volatility into that meeting, but I'm actually still somewhat bullish on the S&P over the next, let's say 2 weeks. Likewise, I'm bearish crude though. I really don't like the look of this chart. It looks very overextended, and I know I just said that the pattern is for a secondary high to occur 2.5 weeks after the max difference from the 50-day moving average, which occurred on this day here, this gap. But we're looking, to my eye, this looks very bearish. This looks like maybe that secondary attempt happened intraday today and then failed. Okay, so if that's the read, then we could see significant downside. I don't know if it's Iran, Russia cooling off, technicals, just getting overextended in price here. But yeah, I do think that coming back to the ratio trade, I do think that puts us at the possibility of getting back to this 50-day moving average. I don't think we'll violate it, although so far the history of this ratio is that it's not respecting that line. So bottom line though is I've reversed from the last time I rapped at you, and I'm now bearish crude oil. Well, short-term bearish crude oil, and kind of sanguine on the S&P. I wouldn't say I'm bullish, but I would say I'm sanguine. Okay, well, that is all for today. I'm trying to figure out how to get back. Here we are, back at you. Yeah, that's all for today. If you got any comments, leave them in the comment section below. And thanks for watching. Bye-bye.